It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today, smartest guy in the room, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Nice sunny day out today as we record it. So, things are going well.
It is a beautiful day. You know, you're an operator of over 10,000 apartment units. It may be sunny outside, but is it cold and rainy with collections and operations in the SPI portfolio these days?
Yeah, no, things are, as we talked about a couple podcasts ago, things are going pretty good. We're no major issues here. You know, obviously it's a problem business, so there's always problems every day, all day, but no major deal threatening issues across the board. So really pleased with how everything's kind of coming out of in the fourth quarter of 2020. Really weathered everything pretty well. I think it really speaks to our structure on the front end and trying to be conservative and how we're putting these deals together and the site selection and property selection and what we choose to buy and where it is and, kind of the stuff that we owned prior that we sold and traded up in quality. I think all those decisions that were intentional back a few years ago really starting to kind of pay dividends. Not saying everything we've done has always been intentional that worked out well, but then in this particular case, kind of selling the older stuff, buying newer stuff, staying away from high crime properties. Those all have been proven to be very wise decisions through the last 7 months of 2020.
We're talking about doing, fairly well. Are you doing that because you're bragging that you guys self-manage your properties? And if you don't self-manage, do you do third-party management?
No, yeah, we use third-party management. So we use a company called Valiant Residential for all our stuff in Dallas and Austin, and they do a good job. And with them for many years, we had another company we started out with that didn't do quite as well, and so we ultimately fired them by selling most of the properties, and we transitioned a couple of the assets at the end over to Valiant, and Valiant's been doing a great job for us for many years. And we just kind of asset manage the deals and stay on top of them. But all in all, they do a pretty good job for us.
So tell me a little bit about that. A lot of people don't understand that third-party property management. In the operating statement, you have a single line that says, management, or it could be a management company. It could be a third-party management company that works for you, is hired by you, is on, retainer with you for, a couple of years, or you can manage the property. So if these are large properties, you have to have management with the property, and it comes as a line item. So you have to understand a little bit about what management is all about. Was it difficult for you to find a property manager? You said that you had one before. Did that one come from you at the beginning? Did you have two property management companies at first? Did you have three? So tell us a little bit about, your run up to your success. How many did you ever self-manage? Did you ever think about self-managing?
No, yeah, we didn't want to self-manage. I'm a banker by profession, and my partner Sean is a financial analyst, and so neither of us really had the big drive to go, deal with HR and construction, deal with the cities, tenant relations, and all that stuff. So just kind of accounting and all the things like that the management companies do for you for 2.75 to 4%, generally speaking, of revenue. So we just always went with the third party, started with a buddy of mine, a boutique firm, and then they got into it. And he's still one of my best friends today, but his partners didn't do the best job that actually kind of ran the day-to-day of it. Not that it was egregious or anything. They just kind of were very flat of an organization, didn't invest in the infrastructure as much as I thought they should. And, we did really well in those assets. So, I'm not trying to talk too bad about them. It just wasn't quite the right fit, and they didn't quite have the same level of, like I said, infrastructure and oversight that we really wanted to have on it. So we noticed some issues that weren't acceptable to us and didn't see the willingness for them to go change. And so we hired another company. I think it was a fifth or sixth deal we owned, Paul. I think it was 6th year. We hired Valiant at the time. They're SIMC management, settlement investment management company, and they did a really good job on the asset that they managed. We kind of put them against the other one, and then they ended up kind of proving themselves to be a little better fit for what we wanted. And then ultimately we just kind of transitioned everything over to them. So they do a really good job. We have some stuff in a secondary market called Tyler that we have another management company manage. We have a partner of ours that kind of runs the day-to-day on that. But, it's kind of done a good job. The management really kind of makes and breaks a lot of these. And I think all in all, if you have the skill set and the willingness to do it, no one cares about your money more than you do. So self-managing is generally probably better from that perspective. But if you don't want to build the infrastructure out, take the time, you can get really good management companies, and there's numerous of them, and in a large market like Dallas Fort Worth or Austin, or in the major metros across the country. There's plenty of management companies out there from anywhere from about 2.75% to about 4% on these deals, kind of depending on the size and the revenue. You get a high quality management company to do all the work for you.
What do you like about your management company? Can you give me like one or two things that you talked about the other management company not putting money into their infrastructure? What does this management company do that you like that you could brag about them?
Yeah, they got good layers, right? So it's not just the president, and then the president's over the regionals, then are over the on-site. So they have a relatively low ratio of regionals to properties. So I think most regionals probably have 5 to 6 assets they're responsible for. Where if you go to a lot of these other management companies, these regionals are 10 to 15, so they have less stress on them. Then they've done a really good job with technology and incorporating that, and continually evolving and improving upon the technology that they implement. And he's not Craig, who's the head of the management company. He's not scared to good or bad, kind of make a change. And so if he's seeing a team member that's not up to snuff, that they're willing to kind of terminate them and move on, and kind of next man up until they find the right fit for a job. So I think that all in all, they take good care and they communicate really well, and I've done a pretty good job of making sure they don't overload their the personnel and cut corners from that standpoint, where that's not what you always see with some of these other management companies.
Management companies, management supervision, management on a day-to-day basis is such a critical piece of your success. I mean, those are the people that really are controlling your destiny. So treat them very well. They don't work. Your employees don't work for you. They work for the management company. So treat them with respect. When you walk into a property, let them know who you are. Give them something to know that you appreciate them, and they'll fight their battles for you with the tenants. And this is kind of in the same vein. The question that came in today, which I thought was a pretty good one, is Michael, I did not listen to you concerning buying in the hood. Now I own 6 properties. Every property is having difficulties. I'm on my 3rd management company in the last, say, 3 years. Any additional advice?
Yeah. Yeah, no, I think that's kind of, as I mentioned when we started, we've been saying I was like broken clock for a long time. We kept talking for I don't know how long we've been doing this podcast, Paul, like almost 6 years. I think we've been doing this podcast, and we've been beating the drum the entire time. Don't buy in the hood, and I've been looking like an idiot because we sold a bunch of older stuff, or people have been buying workforce housing in the hood. I've made absolute fortunes for the last several years, and they're finally they've been, in my opinion, been kind of defying gravity for a really long period of time, and I think gravity's finally hit the marketplace. So those properties are starting to have some operational issues, which makes sense, because it didn't make sense that everything just kind of went up and they made a ton of money, and now there's, like I said, the gravity's kind of hitting where they're having material collection issues, which we kind of notice in our portfolio. The older the asset, the more likely you are to have higher delinquencies. And I think the more that property is kind of more in a higher crime, lower socioeconomic area, the more probably true that statement is. And if it's in, a little bit better location, so older, tougher assets are having problems. So, your collections go down. And then if a lot of these people also compounded this by putting, some bridge loans on them and trying to do these massive renovations where they can go in and, spend $7,000-8,000 a unit on a tougher property in a tough location, and then renovate it and try to push rents another $100-150. I did that with a short-term bridge loan. Then those bridge lenders had kind of the debt funds, and a lot of those guys have compounded it by they go out and spend a bunch of money doing renovations, and the debt funds are a little bit more of a vulture type lender, which is why we never went to them. A little bit more predatory, so they're finding reasons not to fund draws after they just spent a bunch of money. So now you're starting to get liens on your property potentially, and then your collections are going down, so you can't pay your bills, and you're 80 to 85% levered on it on top of that, and then you're having to go to your investors and do cash calls, and they're not going to want to give you cash because you're having a terrible performance in your asset. And then we haven't really seen distress yet in the marketplace, But I think if and when that comes, that is the area where it's going to come, and situations like that, and buying in a high crime, lower socioeconomic area is probably going to be a common denominator we see on the assets that do get in trouble. If you bought, you can buy an older deal, but if it's well located and properly capitalized and you have the proper type of loan on it, I think those deals are just going to do just fine. So I think we're kind of seeing, I haven't really seen it hit the marketplace yet, but we are seeing some cracks in the debt fund bridge loans and the higher crime areas. I think that's a really maybe seeing some early indications. Nothing obviously really kind of trickled through, but I think anecdotally you're probably hearing stories like that. Paul, anything to add?
The other part of that equation really is that when somebody gets an opportunity to invest in somebody else's deal, some of these people that have made LOIs in some of these, let's say, distress asset areas, or could be a future distress assets, but they're offering these unbelievable cash on cash and IRRs on these deals. If you're a limited partner, Michael, how do you make a decision whether you want to invest with that person, invest in that area, invest in that transaction? Any advice for people that, it's too good to be true type of a deal? And how do some people that have $50,000 or $100,000, how can they determine whether that's a good area to invest in? Any words of advice?
Yeah, I mean, really a lot of this is, kind of like we said, kind of have my rules, and one, don't buy on the hood, right? So I think if you buy in a high crime, lower socioeconomic area, maybe that works in the short run, but when, you hit troubling financial times like we have, those are the areas that feel the stress the most. So, if you're in there and you're 7 years into the cycle and prices have, tripled or quadrupled off the bottom, like it was, say, at the end of last year into 2019, when some of these deals are being put together, and then you're needing to get these high leverage bridge loans to make your IRR metrics and your cash on cash metrics look good. So if you kind of look at the deal and it's in a historically high crime area, you tripled or quadrupled off the bottom, and your sponsors having to put 80-85% bridge loans on them to make these deals make sense, and pro forma, $100, $150 rent bumps after spending, a bunch of money in capital improvements. It doesn't take a genius to kind of think that, hey, maybe the structure isn't the most conservative, and the spectrum of outcomes are pretty wide on a deal like this. Maybe I do well and I get my 15 or 18, or maybe I lose all my investment. And I think that's the spectrum of outcomes are, like I said, a little bit wider on a deal like that. So just those are things that I kind of was concerned about for years. And if you go back and listen to me drone on about that for years and be wrong for years, as these people just keep making more and more money, I think, even people I told them not to buy this deal, they bought it. And then 2 years later, they, doubled their money or made 2.5 times their money. And then they think they're, which is great for them. I mean, obviously I was calling it way too early, which I guess is also being wrong. But, I think some of those folks are now, wishing they would have not bought some of those properties.
Yeah. I feel bad for the guy who wrote me the question, just because, they've been on 3, now going to be 4 management companies, and it really wasn't the investor that invested in the deal. It really was them picking the area and the structure of the deal, maybe not going in with enough capital on these deals that eventually they may need to have capital calls. And so that becomes very challenging as an investor, not being able to have the full information about what's going on. So things that I would look at is, my take would be in some of these areas, just crime stats reports in and around the area. Also, too, sometimes you can go on to some of the appraisal websites or the county websites and talk a little bit about the history of the property, and kind of go back 15, 20 years and kind of figure out if that property that you're investing in has a history of being foreclosed upon. I remember there was a property that Mike and I did when you were a banker over off of Walnut that I always said never invest in that deal because it had been foreclosed upon twice in the last 10 years. And so you can find some of this public information about that area where the sponsor maybe think it's a great area, but the market just kind of dictates that this is not a good area, that other people have failed in that area. Take a look at and see if there's been foreclosure notices, and you can find that through the public records. Anything else?
So yeah, that's a good point, right? I mean, if the property's been foreclosed on multiple times in the past, maybe it's okay to buy the deal if you buy it from the bank. But if you're buying it from on the 3.0 or 4.0 value add business model, that whoever that current owner in that property on Walnut over in Garland is probably having some problems right now, Paul, because whatever physically is wrong about that deal didn't get a whole lot better 10 years later, right? I mean, obviously I know that there's capital put into it, but having a flat roof chiller deal with a creek in the back that had some flood zone and some crime issues and bed bugs and whatever else were going on when we were on that property, a decade ago. Times like this will probably stress that property again, and I bet you whoever owns that now probably has a bridge loan on it, and they're going to get foreclosed upon, unfortunately, and at some point, that's kind of how the nature of that beast is. So I think, yeah, fundamentals of the deal, again, kind of I think the four rules really are, don't buy in the hoods, buy in better located, lower crime, higher socioeconomic areas. It doesn't have to be, Beverly Hills, right? It could be, a decent suburb that has, employment and major access to highways and thoroughfares and better school districts. Those are kind of things that we focus on, making sure you have proper management in place and making sure you have, good third-party management company if you don't have the skill sets to run that yourself, making sure you come to these deals well capitalized, making sure you have a good physical inspection, set aside enough money to cure all the known deferred maintenance items, as well as implement your business plan, and then, put the right type of loan on these deals. Don't over leverage these deals. If you go a little higher leverage, maybe take a little longer term on your loan. But if you want to take a shorter term or bridge loan, maybe lower the leverage. These bridge loans we did a few years ago. I mean, Paul, we did some bridge loans, but we're in the 60s leverage, not in the 80s leverage when we're doing these bridge loans. So, if you're going in high crime area, high leverage bridge loan, short maturity, I mean, you're just kind of asking for, potentially some problems, really. I mean, to be honest with you, just fundamentally setting your deal up with more risk. And so, like I said, the last several years, I kept saying it doesn't matter because the market's bailing everyone out, but at some point it's going to matter. And in 2020, I think it's starting to matter operationally, and then we'll see if that actually translates into actual foreclosures and some of these deals hitting the marketplace. Hasn't happened yet, but I think we're seeing some of the cracks right now, and maybe in 2021, some of these debt funds will take these properties back, foreclose on the loans, and will unfortunately wipe a bunch of people's equity out.
Yeah, or they'll have to have capital calls to bring it down to the point that they could refinance it out of the bridge loan. So instead of paying capital when they first bought it, for the larger down payment, they're going to be paying a capital call to be able to refinance that property, 2 years after buying it, not being able to get the higher leverage because the value just hasn't gone up.
And we'll see how well that's received by the limited investors. I would imagine that's not well received if you burn through the initial equity slug to try to go get some more. And then these sponsors that have, like the gentleman that they emailed in, you sound like he had 5 or 6 deals, and he, maybe he sold some stuff and made a bunch of money over the last few years. But, that money goes away pretty quick. When you have 6 or 7 deals to feed, there's only so many deals you can feed at the same time. So it's not like they likely have a war chest of cash to go solve all their own problems with.
That's exactly correct. One deal may be solved, but you have other four or 5 deals that you own that are not going to be solved. And if you're a limited partner in those deals, you may have a problem. So, let's stop talking about bad news. Let's talk about good news, and tell us a little bit more about SPI and what you guys do.
Yeah, really, if you want to find out more information about us, the best way is to go to our company's website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form, fill that out, and we're always happy to have send out some information about what we do, and potentially, getting on into our database and seeing future opportunities from us, and really what we're focused on right now, Paul, really is just kind of finding high quality deals, taking advantage of this historically low interest rate debt, this unbelievable debt that we're able to get with, Fannie Mae and Freddie Mac right now. It's just absolutely unbelievable. And I think the life companies are about to come back into the marketplace in a pretty big way here when 2021 rolls around. They've been largely on the sidelines. I think they're going to start getting a little bit more aggressive and, further the competition. So, that's a very large part about what we do, and it's what you do all day, every day, Paul. So I think, people are interested about, seeing some of the opportunities that are not in high crime, lower socioeconomic areas that are, good quality deals with, experienced sponsors and professional management and properly structured from a capital stack standpoint. Just go to our company's website, and we're happy to start putting that stuff in front of everybody.
So people can invest with you as a limited partner into the transaction. So they actually are buying into a hard asset. So you can invest, your 401k or IRAs into stocks, bonds, or cash, or mutual funds, wherever you want to invest in. But if you were to have an IRA, a self-directed IRA, it could invest into real estate too. So typically, the self-directed IRA, you can make decisions whether if you want to invest in the stock market, if you want to invest in the bond market, or you want to be exposed to some other type of alternative investing, which would be a limited partnership and putting money into a property, let's say with Mike, alongside Mike. And so that is an opportunity that Mike and his group over at SPI give you the ability to partner up with them in those transactions. So, Michael, anything more?
That's it. I appreciate everyone listening. Appreciate everyone that joined the Old Capital Conference. Just kind of got done. Maybe next time we can do a little recap of kind of what we learned on the conference.
Sure, we loved it. That was a great one. So we appreciate everybody being here. And I'm Paul Peebles, Michael Becker. Have a great day.